and I am looking at the Australian dollar USD again on a daily time frame. And this prompted me to actually jump over to my DXY analysis that I put out the other day, and was anticipating it to eventually be bullish. I was basing that validation on an upward sloping and downward sloping trend line that created a sideways triangle. And this is why it's a perfect example of why you use stops and losses, and you have to be extremely tactical in the Forex market. It actually broke down and broke through the bottom trend line and is actually way oversold, much more oversold than it was on a stochastics level, which I have to go back and actually look at that. It's at another support level, and it's creating what looks to be another pattern. This prompted me to look at it because the Australian dollar is actually looking bullish in higher time frames, which made me concerned about the Australian dollar, as it's hard for them to both be bullish, even though the dollar is weighed against other currencies, not just the Australian dollar. So you can't look at the DXY just with respect to the Australian dollar, but it does hint to what's actually going on. But jumping down to the daily chart here on the Australian dollar, I added some Bollinger Bands, and you could see the Bollinger Bands. What Bollinger Bands are they're basically a 20 period moving average, or whatever period moving average, which if you choose a 20, a 55, normally it's a 20 period or somewhere around there by default, and every 20 periods, a simple moving average recalculates. So whenever it gets to the 21st period, it drops off the previous one and it recalculates the average. So if price is dropping, the average is going to start dropping, and price will cross through the average, and the average is slow to catch up as it recalculates other candles, and that's essentially what it is. The Bollinger Bands are simply the moving average with another moving average 2 standard deviations above it and below it. The theory is this: in statistics, 98% of the data should theoretically, or 99% of the data should reside within these 2 standard deviations. If you increase it to 3, then almost 100% of the data should reside within it. So when you see pierces outside of these moving averages, it's a high probability that it should go back into it. I mean, you can see how many times do you see it pierce outside of it. And when you do see it pierce outside of it, what happens? It comes right back. Comes right back. So at least over the short term, you can make I'm confident you can make money going long here over the short term. And here's exactly what I would do. You can see that we have some indifference candles, which indicate a reversal, at least over the shorter term. We're at that higher level weekly confluence that I mentioned in my other videos. We got stochastics that are oversold at, and I'll give you a more pictorial view of what's going on here, at this level right here, and they're almost obeying it. This is a very, very clear trade. I mean, this is something I'd be extremely confident in, going like doing a almost like a little swing, not necessarily a scalp trade, but something that you might want to be able to capture 100, 150, 200 pips. I haven't really looked at it yet. When I get down to this level on the next time frame, I'll show you what I mean. So that pretty much sets us up right there, and that's all I need to see. We got the confluence here. We got the indifference candles outside of the Bollinger Bands, which won't last. Trust me, you can see that. You can go back historically, back test it. You'll see that they won't last. And what I'm going to do on a lower time frame is I'm going to use Fibonacci to know when it's going to retrace. And I would actually do, I'm almost confident enough to do a buy at the market, but I mean, I would still zoom down and do some buy limits. But you can see here where I'm going with this. And definitely watch my next video to see what I'm going to do on the lower time frames. Thank you.